We heard that all the banks passed the stress test. That was to be expected. Does that mean that they're all going to get what they want in terms of being able to return cash to shareholders, or do the two have very little in connection?
I mean, there is a big connection, because several years ago, in this first stage, they didn't necessarily pass, or they were so close to the minimum levels that we suspected they would fail.
But they figured it out. But
the last several years, the numbers are much higher because capital levels are higher. So even under a bad stress scenario, it drops, but it doesn't drop too bad. So where they have failed in the last few years is the qualitative portion, which we will hear about next week. And that looks at other things such as how they really do risk management, how their data control mechanisms are, corporate governance, all kinds of fuzzy material that we don't even really know what it is.
All the really important things.
Right, well, very important, and they can fail on that.
So, Josh, all clear? Should we take this news and assume the financial system is safe and healthy and not worried?
No, I mean, one of the things
I had a feeling you were going to say
well,
no.
One of the things that I find kind of humorous is when we first started with the stress testing in the wake of the crisis, the markets didn't believe them. Now I think we have too much faith in them. They're a wonderful indicator. That's all they are. And frankly, they're a better indicator of what we're going to see in terms of allowable payouts, which we'll see next Wednesday, than anything else. The Fed each year focuses on a different portfolio to prioritize in the stress. This year it was commercial real estate. Well, if you look at commercial real estate, the portfolios are in good shape across the board. ALLL levels are good across the board.
Wait, what's that?
The loan loss reserves for those portfolios are good across the board. As I've been saying for the past year, my concern is that the fastest growing portfolio in bank balance sheets over the past 5 years has been commercial and industrial loan demand, and I've been concerned about reserving there and delinquencies. And if you go look at B of A and Wells especially, you've seen massive spikes in delinquencies. You haven't seen a corresponding increase in provisioning. And so I think that it's not a great indicator. Same with farmland or agricultural lending. You've got some real problems in portfolios. So I think you have to stick to your fundamental analysis, portfolio by portfolio. This should really be looked at as a way to get a handle of what the payouts are going to be.
You're saying the banks are underpricing the risks that they've got in
Some of them are. Some of them are, yeah.
How badly?
Terribly. So the average yield on a C&I portfolio at major banks prior to 2011, or in 2011, was over 5%. Now it's hovering at about 2.5% to 3.25%. So they've been underpricing to buy business. They haven't been increasing the reserving, and if you look at the delinquency numbers, they're starting to spike over the past year at a large number of the banks who've been growing the books most aggressively. On top of that, if you look at B of A as example and Wells as example, almost 22% at B of A, 17% of Wells, of all of their loans are in C&I. So residential real estate as a percentage of their book is tiny. It's less than half of that.